So we are going to break down a high cash value life insurance policy. To begin, to kind of set the stage here, I'll start with a story. This involves a conversation with someone we work with. He took a policy out through us over the years. It's been about 1.5 years, 2 years in working with him. We've developed a relationship where I really consider him a mentor from a business perspective and a friend. I really enjoy our conversations. But what I really liked is when we first connected, we're talking about cash value life insurance, how to design it. He had worked with several agents over the years designing high cash value policies, and he referred to it as this black box. You know, you take a whole life insurance policy, Steve, or any cash value life insurance policy for that matter, it's like this black box where you've got all this stuff going on in there. And you can, I don't know if I quite said this, but I'm going to kind of put words in here. You can reach your hand in that box and pull out a product that looks really good, or you can reach your hand in that box and pull it out and you don't have a hand anymore. It got bit off because the product wasn't set up properly, or I was undereducated. Something happened. So point being, we've got all these moving parts, all these moving pieces with the cash value life insurance policy. How do I make sure it's set up properly? How do I make sure I've got the proper knowledge to ensure that I don't have buyer's remorse down the road? That's the kind of stuff I want to know. So some examples. When it comes to the guaranteed rate or even a dividend rate, let's say that I have a dividend rate of 6% with a product with an insurance company. Does that mean I am earning 6% on my cash value? My net internal rate of return, will that be 6%? No. The reason why is that the dividend rate and the guaranteed rate as well is a gross rate that is credited after the cost of insurance, after the mortality charges. It's good to be aware of that, so I don't think that I'm going to earn 6% and then find out after the fact I'm only earning 4%. That, no one likes to find that out. If I think I'm earning 4% and then I'm earning 6%, hey, I'm good with that. But we want to be aware of that up front. We've got the base premium, term rider, PUA riders and fees. You know, when you take the base premium, dollars I pay towards that specific component of a life insurance policy, the company will overcharge me for the premium up front, and then eventually, typically beginning the second or third year, depending on the product, these dollars do come back to cash value for me. Term riders. These can be level term riders. They can be 1-year renewable term riders. It can be set up where the term amount decreases, so my net costs decrease. We've actually got content solely dedicated to this. One video is entitled, I believe it's OYT, 1-year term rider, full transparency, where we go through a full breakdown of how that rider works and how to make sure we set it up properly. Then you've got PUA rider fees. When you pay money into the PUA component of a life insurance policy, that accelerates your cash value growth. That's the key to optimizing everything. Yet, if I have a PUA that I pay into a policy with a 6% dividend, and on paper their PUA rider fee is 8%, it makes it look like I'm never going to earn any money. It does, but it's a bit misleading, as you'll see a positive net IRR or positive return on cash value once I get into it, usually 2 years. And we're going to demonstrate that here in a minute as well. Then I've got different companies, different products, different funding periods. Maybe I want to make the policy very flexible, where I can commit to a small amount and have the ability to add more funds at leisure. A lot of ins and outs there, depending on the product, the design, the company selection, knowledge I want to know up front, so I can make sure that the product inside of that black box is set up for optimal performance. Then I've got the death benefit and MEC laws. When it comes to that modified endowment contract, we don't want that. If a life insurance policy becomes classified as a modified endowment contract, the MEC, I have to deal with taxes and potential penalties. It's not pleasant. Now, any life insurance policy can become a MEC, but what the limit is, what determines whether the IRS will view a life insurance policy as life insurance or a pure taxable investment, is the death benefit. Our age and death benefit, think of it this way, are the measuring stick that the IRS uses to determine if a policy will be viewed as life insurance or a pure taxable investment. Interesting, isn't it? Now, if I'm going to pay money into a policy, we're going to pretend that this is my black box. You can tell I was not an art major at school. So I'm going to pay money in here. What's going to come out of that box is more money, and I'm going to have a smile on my face, or less money, and I'm not going to have a smile on my face. What's interesting about this is you can pay the same amount of money in with the same company, the same product for the same number of years, and you can have one of these two results, or anywhere in between. That's why it's often referred to as this black box or this mystery inside of the product, because it's not cut and dry. Like if I put money into a 5% bank account, if that existed, I'm going to get 5% on that. Pretty cut and dry. Not the case with a life insurance policy because of all the moving pieces, all the moving parts. Here's the most important thing. If you get this right, company selection and policy design, everything else will fall in line. Specifically, the policy design. Money can go toward premium or PUA at the end of the day, and a term rider, but the base premium, and PUAs. If I know how to optimize the cash value, I'll be satisfied as I'll have rich equity up front, in addition to strong long-term cash value as well. What I always focus on is how do you optimize your cash value? Because if you have more money in cash, that gives you more money to work with, regardless of if my goal is just to grow cash value or use the policy for the banking concept, to pay off debt, invest in real estate, whatever it might be. How do you give yourself the most money, put yourself in the best position where you can use it to the fullest? See what I mean? All right, so let's break down the policy. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.